Imagine for a moment that you have just checked your bank balance late on a Tuesday night, and the numbers tell a story you did not intend to write. There is the paycheck that arrived 5 days ago, already reduced by rent, by utilities, by the automatic payment to your credit card company. And yet, that credit card balance seems almost untouched, as though the payment you made was absorbed into a void that demands the same sacrifice again next month. You are not behind on your bills, and you are not reckless with money, but there is a quiet pressure building in the background of your financial life, a sense that no matter how carefully you plan, some invisible mechanism pushes back just enough to keep you exactly where you are. This is not bad luck, and it is not a failure of personal discipline. What you are feeling is the friction of a system designed to transform short-term convenience into long-term dependency. And once you learn to see the gears turning beneath the surface, you will understand why so many people who play by the rules still find themselves running in place. The core concept we need to examine together is what we might call the debt spiral algorithm, which is not a literal piece of computer code, but rather a behavioral and mathematical architecture embedded into modern lending products, an architecture that lenders have refined over decades to engineer gradual, self-reinforcing dependency rather than one-time profit. When most people think about how banks and credit card companies make money, they imagine interest as a simple fee for borrowing. But the real engineering happens beneath that surface, in the timing of payment due dates, the calculation of minimum payments, the structure of credit limits, and the psychological cues that guide borrowers toward specific choices. The algorithm works because it exploits two very predictable human tendencies. First, we consistently underestimate how long it will take to pay off debt when we make only minimum payments. And second, we consistently overestimate our future ability to make larger payments. Lenders do not need you to default on your loans to profit from you. In fact, default is a failure of the algorithm. The ideal borrower from the lender's perspective is someone who remains solvent but never quite escapes the revolving balance. Someone who pays interest month after month, year after year, without ever triggering a charge-off. This is the sweet spot of the debt spiral algorithm, and it is achieved not through coercion, but through a carefully designed choice architecture that makes the most profitable decision for the lender feel like the most comfortable decision for the borrower. The psychological machinery behind this algorithm rests on three well-documented phenomena in behavioral economics, and understanding each one is like putting on glasses that bring the fine print into focus. The first phenomenon is called hyperbolic discounting, which is the human brain's tendency to prefer smaller, immediate rewards over larger, delayed ones, even when the delayed reward is objectively better. When you decide to make only the minimum payment on your credit card, you are not being lazy or irresponsible. You are responding to a very real biological preference for preserving cash today rather than saving a larger amount of money next year. The lender knows this, so they design the minimum payment to feel painless, typically between 1 and 3% of the outstanding balance, which is low enough that you barely notice the outflow, but high enough to keep the account in good standing. The second phenomenon is the pain of paying, a concept studied extensively by behavioral economists like Drazen Prelec and Duncan Semester, which shows that people feel less psychological resistance to payments that are small, frequent, and automatic. By breaking your debt into tiny monthly chunks, the lender numbs you to the true cost of borrowing, because $50 in interest feels like background noise, while $500 in interest would feel like a crisis. The third phenomenon is the illusion of progress, where people persist in an activity not because it is working, but because they have already invested effort in it. After you have made 12 minimum payments on a credit card balance, the thought of stopping or changing your approach feels like admitting that those payments were wasted. So you continue, even if the balance has barely moved. Lenders understand that once you enter the spiral, your own psychology will fight against you when you try to leave, because leaving requires acknowledging that the past payments did not achieve what you hoped. Let us walk through the math slowly, not to overwhelm you but to show how the numbers create the trap, regardless of your intentions. Suppose you have a credit card balance of $5,000 at an annual percentage rate of 22%, which is roughly the average for new credit card offers in many Western economies as of recent data. Your minimum payment is calculated as 2% of the outstanding balance, which on $5,000 comes to $100 per month. If you make only the minimum payment each month and charge no new purchases on the card, how long will it take to pay off the balance, and how much interest will you pay along the way? The answer, calculated using standard amortization formulas, is that you will need nearly 30 years to eliminate the debt, and you will pay over $8,000 in interest on top of the original $5,000. 30 years of payments to retire a $5,000 balance. But the algorithm does not stop there, because while you are making those minimum payments, the lender will periodically offer you a credit limit increase, which feels like a reward for your good payment history, but is actually a way to encourage new spending. When you accept that limit increase, the balance grows, and the minimum payment grows with it, but the ratio of payment to balance stays constant, so the time horizon stretches even further. If you increase the balance to $8,000 under the same terms, the minimum payment rises to $160 per month, and the payoff time extends beyond 30 years to approximately 40 years. This is the mathematical heart of the debt spiral algorithm. The lender structures the repayment terms so that a borrower who never misses a payment and never defaults can still spend decades paying interest on the same core balance. And because inflation erodes the real value of money over time, the lender profits even more handsomely than the nominal numbers suggest. The algorithm does not need you to fail. It only needs you to remain comfortable enough to keep making those small, painless payments forever. When we zoom out from the individual experience and look at the broader financial system, the debt spiral algorithm reveals itself as a structural feature rather than a bug, a design pattern that has been optimized across multiple industries, from credit cards to student loans to auto financing. Historical parallels are instructive here. In the early 20th century, the introduction of installment credit for automobiles and household appliances created a similar dynamic, where manufacturers realized that financing their own products allowed them to sell more units at higher effective prices while keeping monthly payments low enough to feel affordable. The difference today is that the algorithm has been refined using data science, machine learning, and massive-scale A/B testing, so lenders know precisely which payment amounts, which due dates, which notification messages, and which credit limit increases will maximize the probability that a given borrower enters and remains in the sweet spot of perpetual solvency. There is a quiet tragedy embedded in this system, which is that the people most likely to be caught in the debt spiral are also the people who can least afford the long-term interest costs, not because they are financially illiterate, but because they have less margin for error in their monthly budgets. When you are living close to the edge of your income, a low minimum payment is not a convenience. It is a lifeline, and the algorithm is designed to make that lifeline feel like a gift while slowly tightening around you. But the systemic nature of this trap also means that escaping it is not purely a matter of individual willpower or better budgeting habits. Recognizing the algorithm is the first step, but the second step is understanding that the system is optimized for your dependency, and therefore your path out must be intentional, strategic, and often counterintuitive. The shift in identity that makes escape possible is subtle but profound. And it begins when you stop seeing your financial behavior as a reflection of your character and start seeing it as a response to engineered incentives. You are not weak for having made minimum payments. You are acting rationally within a system designed to make that choice feel like the only reasonable one. The person who escapes the debt spiral is not the person who suddenly becomes a financial genius. It is the person who realizes that the game is rigged and decides to stop playing by the lender's rules. This might mean making a larger payment than feels comfortable for a few months, or transferring a balance to a different product with different incentives, or simply accepting a temporary reduction in lifestyle to break the cycle before the algorithm resets. None of these choices are easy, and none of them come with guarantees, because the external system does not change just because your internal perspective changes. But the calm, analytical truth is this: the debt spiral algorithm works only as long as you remain inside its choice architecture. Once you see it, once you name it, once you understand that the small, painless payment is not your friend but your jailer, you have already taken the step that most people never take. You have moved from being a passenger on the spiral to being an observer of it, and from that vantage point, the path out, while not simple, becomes visible. The algorithm is patient, but now, so are you.